Hello, this is a review of the ICT Bible. I'm Trader Sumo, and do I believe the claims that I am reading? The ICT Bible Introduction to ICT Concepts by Ali Khan. So why am I making this video? Well, I posted a tweet. I said I downloaded this video, and if the tweet received 50 likes and 50 retweets, I would start dissecting each lesson and showing you the flaws that I believe this method of technical analysis uses. So what does this do? Why am I doing this? Well, one, my friends tell me I need to make content so that people find out who I am. And two, for business purposes, it gives me saturation into this market because I know this individual is a prolific voice in the trading community. Many of you follow him. Many of you are studying his concepts, and many of you, I assume, are probably not doing that well. There are plenty of people that do support ICT, and they say that he's the best, and there are plenty that do not. And what happens is you get a large echo chamber, I believe, when you get on social media, and essentially everyone's charting and trading method looks the same. And when everyone is wrong, they're really wrong, and everyone's right, they're really right. So, like I said, I don't have any ill will towards ICT. It's never harmed me personally. I do have a bias towards my opinion. I do tend to think that he's kind of ridiculous, and especially from reading this. But I know that he didn't write this PDF. Someone else is basically taking his method and extrapolating it into a form that can be easily digested. And basically, I'm going to review that. Now, ICT has hundreds of videos on YouTube, and I personally am not going to sit and watch all of them for hours and hours. I have 15 years of trading experience. I have learned my own trading methods. I've simplified a lot of methods of people that came before me, and I am where I am today, irrespective of anything ICT teaches. So now I know many of you will be upset. You're going to see this video and you're going to think, I don't like this guy because he's talking negatively about my mentor. Well, that's fine. It's an old Chinese movie. Whose kung fu is better? Go to the town. Which sensei is better? And hopefully I will show some of you, there will be some of you that this will resonate with, and you will see it for what it is in at least my view. And maybe that will help you. Everyone else that are convinced that I'm crazy and that everything I say is irrelevant, so be it. This video is not for you. It is for the 100 or so people that like this tweet, because they're actually interested in learning my viewpoint on his techniques. Okay. So who is Trader Sumo? There you can see me on the left. I am in Kevlar, and a Kevlar helmet, a bulletproof vest, whatever you want to call it. I'm sitting in a helicopter flying in the Middle East. I spent 10 years within the intelligence community, 4 of them in the military, and then 6 of them, or actually a little more than 6, in the NSA, the National Security Agency. I was an intelligence analyst, and here I'm showing you my credentials, that I hold a top secret clearance, and I have a bunch of other accesses, etc. But this is so you can see that when I tell you something, I try to back up and show you the credentials, try to show you what I believe to be the truth. This is my information. This is my record. You can look it up on jpass.com or jpass.gov, whatever it is, if you had access, okay? But you're not going to have access. So point is, most of you aren't going to know what this means, and it's irrelevant. The point is, I'm showing you my credentials. Now, also, here I am in the military going through an electronics signals intelligence school. Basically everyone that goes into the military, they get a job and they learn a skill. My skill was signals intelligence, is how I started. And basically, if you look in the back, here in the back of this video, this picture, there is a surface-to-air missile system, and that is what I specialized in while I was in the military. And this will become important because anything that uses radio frequency or RF energy is the reason it's important is because energy moves in a waveform. RF energy moves in a waveform. And what I found is when I transitioned into the markets, I noticed that markets are essentially a waveform, and the energy is essentially the buying and selling, the trading that is happening within a market. So I thought that was interesting, and I sort of used that skill as I transitioned. Now, on the right of the screen here is a document that I took a picture of when I was leaving the Air Force, and it's basically just saying that my training records would be destroyed once I left or out process, which means once I leave the military, all of my training records would be destroyed, so that essentially it's a security protocol, so that if anyone were to ever find my records, they would know, all of the things that I did, which they don't, they, once you part ways, it's kind of like burn notice. You don't, they don't want this information somehow getting out. Now, I'm also listed in WikiLeaks. If you're familiar with Edward Snowden and all of those, the big intelligence leaks that came out, I worked with some of those systems that there's a lot of information that he leaked, but I worked with some of those systems. Okay, now moving on. Who is the Inner Circle Trader? The Inner Circle Trader is a prolific trading educator. He has hundreds of videos on YouTube, a following of a few 100,000 on Twitter. He's a giant voice for a lot of traders, especially new traders. Now, this video is not going to be for many of you. This video is for only a few of you. Again, when you see what I'm going to show you, some of you are going to be upset. You're going to be in disbelief. You're going to think that I'm attacking him, and I am not. I'm simply just showing you what is there, and I'm going to analyze the information that is put in front of me and tell a story and give you a bias that I have. Your opinion may differ. So who is the Inner Circle Trader? I found this post that he had made. I believe it was on Baby Pips, or it was an internet forum, and basically he is saying that from his experience, the logo that he created was applied to circles that was on a passcode, or a cipher lock is what we would call it, to enter offices that he was taken to. He was saying that he wasn't permitted to see the way to the office, and he had to ride in the back of a closed van without windows. I am someone who spent time in the most secure facilities in the world, and I never rode in the back of a van blindfolded. Okay, so it's a little bit silly. Take it for what it is. I don't necessarily believe this story, but I just thought I would put it out there so that you're aware of what we're dealing with. Here's an email that he allegedly wrote. I do not know for certain that he wrote it, although as an intelligence analyst and using that background, I would lean towards more that he did, but like I said, I don't know. He basically says that he is wealthy. I believe here he's saying he made over $30 million trading futures, and he traded a $200 million fund for a corporate entity downtown in Baltimore since 2007. Now, that is going to be important information when we talk about Baltimore, because that is where he's from. Now, what is also really important is he says, I have 5 children. All of them have $2 million trusts or trust funds, and the 2 older children have homes that he purchased between 2013 and 2014. And those homes, they're not mansions, but they're respectable homes in the $500,000 range. A $500,000 home in most places in the United States is a large home, especially in that time. That would be a very large home in 2013 in most places. Now, not all places, but most. Now, this is where it gets interesting. I said I was an intelligence analyst. That means I am especially skilled at finding information and analyzing information and painting a picture and trying to decide, is this story true? Here is a document, an affidavit filed with the Registry of Deeds office in Maryland. He filed as a first-time home buyer. Here it says first-time home buyer, and Michael J. Huddleston, which is who he is. It's well established. He has no problem saying his name. I'm not doxing him. And I have removed his address because I don't think it's important that you know. But I just want to show you that I have the documents. I actually have the documents to all of the properties that he has ever owned, because we are, as citizens in the United States, are required to file those documents with the public registry, right? So it's a public registry. Anyone can go look this stuff up if you know where to look. And then basically in April of 2013 in Baltimore, he purchased this home for, I think it was about 130 something thousand. I didn't include that because there's just no need. I think it's pretty established that I'm giving you a legitimate document. But he purchased this home. The first home that I think that he finally purchased was that was over that 500,000 mark, where he's telling us that he purchased a home for, what did he say, 500K here. So the first time he did that was 2018, I believe. Might have been 2016, but he lived in that home for a while, and it was about 600K. And now he's recently purchased a home that he paid cash for, as far as I could tell. That was approximately $2 million. Still, all of these properties were in the Baltimore area. Now, here is an email that I know that he sent. And he's basically calling someone, telling them that they're bipolar, and that he knows they're bipolar because he is bipolar as well. Okay, that's what we're dealing with. What has been will be again. What has been done will be done again. There's nothing new under the sun. Now, this is a passage from the book of Ecclesiastes. It was written by King Solomon, who is said to be the wisest, most wealthiest man on the planet. And I'm telling you this because he is telling you in this scripture that things that you see have already been done before. There's nothing new. Everything that you see, everything that you do, someone else has already done it. Someone else has already experienced it. Someone else has already thought it. Okay? Why am I saying this? Well, this is a piece of information that I found from an old timer named Richard Wyckoff. He was a prolific technician or market analyst back in the early 1900s. And he helped develop this idea of the structure of markets. And essentially, if you look on the chart, this is basically his, let me back this up. If I can get it to work here. One sec. Okay, here we go. Basically, he's got a chart of an old-timey chart from, it's a point and figure chart. It looks like that he's hand charting the price of the markets. And then it was kind of extrapolated into a modern form where you get the basic accumulation, the trending phase, and the distribution phase of markets, which him and another gentleman, Charles Dow, which the Dow Jones Index was named after, essentially came up with this theory from what they observed of how markets moved. Now, what we have, this becomes the ICT market maker profile, and here you can see him. And this is basically, he's essentially taken the Wyckoff or Dow application and basically just called it his own, made a few minor changes, and said this is the market maker profile. And he doesn't really give anyone credit for this, but it's pretty obvious the similarity if you know where to look and you're paying attention. Okay, which basically I'm saying it's, just kind of funny meme. It's the same thing. It's the same thing, Grandpa. Same shirt. Okay, now we're getting into the PDF finally. The algorithm. The algorithm is responsible for moving price in the market, says ICT. It says we are taught that prices move from buying and selling pressure, and that the direction of the market is determined by which side has the largest inflows of cash. This is false. Now, the reason why I don't like this at all is because this is basically auction theory 101. This is supply and demand, and it's relatively accepted as true. He's basically saying that, he goes on to say, the truth is they, as in whoever they is, the market in general, I guess, or the elites, are not going to let the entire financial system be at the mercy of random buying and selling, which is an untrue statement. We know that that is untrue, because if that were the case, markets would never crash. And we know that there have been plenty of market crashes in modern history. Just take in 2020, 2019, we just had a significant crash that ruined a lot of people's lives financially. And he goes on to say that it's better to use an algorithm to automate the markets more efficient and reliable, which everyone knows at this point that algorithms are being used by market-making firms or large conglomerate investment companies. Will just say, yes, they do use multiple algorithms to enter and exit markets. This is not anything new. Here he's calling Michael ICT the engineer of the algorithm. The engineer of the algorithm. So there's one algorithm, and he is saying ICT created it, and that he calls it the interbank price delivery algorithm, which is kind of a play on words. That it reminds me of central banks setting interest rates via an algorithm. He's basically saying that this algorithm, this one algorithm, controls the market, and it manipulates people into getting into the market. And so to engineer liquidity, which throughout this entire work that I have read, they use the word liquidity improperly. They use the word liquidity to mean stop orders, which is a form of liquidity, but it is not liquidity. Liquidity refers to how easily a market can be traded, how easily it moves. For example, the S&P 500 is an extremely liquid market compared to, say, oil or gold or something more obscure that is not traded as frequently. So the more volume something has, the more liquid it is, the easier it is to get involved. And he's saying that the algorithm is manipulating people's opinion of the market so that they will take trades and in turn create liquidity in the market, which is kind of silly, but whatever. Okay, moving on to the accumulation, manipulation, distribution. What I found is that ICT basically re-engineered this term. These terms come from Charles Dow and Wyckoff from the early 1900s and late 1800s. And I'm giving you the definition. The generally accepted definition of accumulation means the act of buying shares of a security without causing the price to move. And then clearly and specifically, it says after a decline. So after the market has traded down. So after a move down, you'll get a sideways market that really doesn't move significantly. That's accumulation, okay? So he's somewhat correct, but you'll see where it gets kind of ridiculous. So then he basically says that this algorithm holds the range and it allows liquidity to build up, which he's saying buy stops below the range and sell stops above the range. And then basically once it moves out, that's the manipulation phase, that people are being manipulated. And I'll show you what this actually is in a logical fashion, because what I hate about a lot of TA methodologies is that they're based on an assumption that you cannot prove. You as a trader do not have access to tell me for a certainty that there are buy stops resting here or how many, okay? Now, for sure, we can assume that there are buy stops and sell stops above and below swing points in the markets, but that does not tell you how many. It doesn't tell you how much they're going to move the market if they are hit. There's so much unknown that you're having to assume, and that's silly. And I hate assumptions when you're trying to use logic and rationale to explain why something is happening, okay? So we'll move on. Here he talks about distribution. Basically, that is the opposite of accumulation in terms of the actual definition here, okay? But what he's saying is essentially once price is below these lows, the price is said to be distributing. And I think that is obviously counterintuitive to what the accepted definition is. The accepted definition clearly says the systematic selling of a security that doesn't really significantly affect the price. And again, the key, after an advance. So basically, you would have to think about it as the market moved up, it trades sideways, and then it sells off. So this sideways action is the distribution. Okay. So that's basically what he is saying in this book. And again, people are being manipulated in this point. He's saying that their emotions are being manipulated and that they try to get long and then the market turns against them. Well, what's actually happening, we'll get into this shortly, is that this point right here is actually testing a level further left. And I'll get into all that in a moment and show you what it actually is. Now, there are 6 basic tenets of Dow theory, but what I wanted to show you is that the market trends, this is a known theory from Charles Dow. Again, that the market has 3 trends, 3 phases: an accumulation phase, a public trending phase, and a distribution phase. And that's really all I wanted to take. So ICT talks about the power of 3, talks about these phases in the market, and this is really where it comes from. Again, giving you my background, something that I noticed is that the markets move in a wave form. You might have heard of Elliott wave. I'm not saying anything about Elliott wave, but I am saying we can observe that the markets tend to move in a sinusoidal wave pattern. Now, basically, again, when you have energy that is moving, and the way that we plot it, the way that we use it graphically is we use it in some sort of waveform. Now, it doesn't have to be this nice, perfect waveform that you see. It can be extremely violent looking. It can be sawtooth. There's all kinds of other waveforms, but essentially it follows this general principle. Okay. And that's all I'm showing you. And basically what you're having here is the degrees. If you were to think about, this is one way to think about a circle, and this is a 360 degrees in a circle. So if you start and you work your way around, that's basically showing you a 2-dimensional version of phases within the market. Now, you'll see in the next slide, I believe, that this is essentially the Wyckoff model, which is the accumulation at the bottom of the wave, or the waveform, the sine wave, the distribution at the top, the consolidation here, the accumulation, distribution, the trend up and down. So it's essentially the same thing people have noticed, and that's what it's been generally accepted. Now, what I'm going to show you is that basically this is the pattern for trend in the market. So the markets trend down, they consolidate, they trend up, they consolidate, etc. And then they make new highs or new lows. And we'll get into that. So basically I'm showing you that you have a market that's uptrending. You have multiple trends. A lot of people forget. Now, there's a couple things to extrapolate from this slide. Basically, obviously, the market is trending upward. We all know what a trend is intuitively. Trend simply means to continue doing what you were doing before. So if you're moving forward, Newton's first law of motion, things that are in motion tend to stay in motion until a force is applied to them to make them stop. Same thing happens in trading. The force is essentially orders volume, or trading liquidity, which is just simply volume, or simply traders in the market trading, betting one way or the other, essentially order flow, markets moving through orders moving through the market create trend. And it's a phenomenon that happens as a result of buying and selling and people trading. I mean, that's just simply what it is. Now, what a lot of people don't know is that there is a rule system that we can use. And I have developed an algorithm for charting platforms that uses this rule system to identify trends. And what you'll notice is that all of these significant levels in the market are inflection points. So all of these places, when we have buying and selling and their inflections, they're creating levels, right? And most people kind of understand that intuitively, but what you'll realize is as we progress through this PDF, you're going to see that the ICT methodology is overly complicated and basically based around assumption, not fact. So here's part of the ADM, the accumulation, manipulation, distribution phase, and I've given you a real life example that I found. And basically, what I wanted to point out was that the markets, as you can see, the individual Ali Khan drew this, and he just kind of drew this straight. Well, markets aren't ever. They're never going to be, almost never going to be equal like this. Like the highs and lows will rarely be equal, as you can see in the actual consolidation area. Some of them are higher and some of them are lower. So the idea of lower highs and higher highs, etc., lower lows, etc., you all are probably aware of that. But basically what I've done is plotted out trends for you so that you can sort of see the structure. And what is happening here is when this manipulation that the so-called manipulation happens, it's actually creating a new trend in the move up here. So if this were a downtrend, this now becomes an uptrend because we're creating a new high, and that is basic logic. Think about it. If you are moving up in an uptrend, you want to keep making new highs. The moment that you start making new lows, you're now in jeopardy of changing the direction of the trend. So it's just common sense. Everybody knows this, but ICT and that school of thought, none of them actually think about the logic of what I'm saying. They think that it doesn't exist, and they think it's all about engineering liquidity, which is all nonsensical. It's basically I'm pitting you against them mentality, which is silly. Okay, so let's dive into a little bit further. So here's another example. What I really wanted to show you, and I'm saying that high was actually testing a significant level or the start of a big downtrend. Okay, and then down here at the lows, when you get this move down like they're showing in the PDF, it's actually testing something significant to the left that I've cut off the chart. But every level in the market essentially is testing something else in the market. It's testing another significant level or an inflection point in a trend. So if I were to say this is a large downtrend followed by a large uptrend, we can look at why did this candle stop here? It's because it's testing. This is a trend down in itself. This is a bigger trend down. This is a smaller trend. Every little spot, right? If I were to tell you this is a trend down, when we come back up, we're testing the start of that trend and we sell off. And the same thing is happening. So we're creating trends within trends in the market. And all of the significant levels in the market are basically testing them all. So this high. So when the market comes down, it's testing here. And it bounces. What is it doing? It's testing this trend start down. So this area here, and you can see these candles are testing it as well. So it creates a new downtrend, comes back up, tests. And what does it have to do? Well, we're in a downtrend, are we not? So we need to make a new low. So this is low, is slightly lower than this one. So they create a new low that establishes a new trend. Then what happens in the very next candle? We work our way up and create a new uptrend. Well, we've already kind of gotten through this area. We hit it for the first time, pull back, etc. So there is a progression to the market. Without making this overly complicated, you can essentially understand the purpose of every single candle in the market and what it is trying to do if you understand trend and how it is formed and the rules, which I'm not going to get into per se. I just want you to be aware that it exists. Just here, even here, from this low, as we move up, you have a trend down that's created. I have it drawn out for you. Well, what is this? This is the start of that trend down. Well, look what they came and tested. The market moves in this, and if you think about it, what is happening? This is that sine wave form. It's that sine wave. It's the sine wave. It's a wave form, right? And that continues, that pattern happens throughout the market across all time frames, which we're not getting into the, we could get super deep into this, but I'm keeping it simple because the PDF is relatively simple. But I just want to show you what this actually is. Okay, here is kind of an interesting concept. ICT comes up with the fair value gap, and I think it's kind of silly. I mean, I understand kind of how he made it, and I'm going to show you what fair value gaps actually are. and why they form. But essentially he's saying like you basically have a candle and there's a space here where the market, so basically you had to move down and then it moves up and then it doesn't come back. And he's saying that there's an inefficiency here, and he says right here, there's an inefficiency in the delivery, or basically the price inefficiently. It's kind of a silly term, and you'll see. The reason, I'll show you in a minute, but the reason why it doesn't come back there is because that further to the left, there's a downtrend and there's a level here that it's hitting. But I'll show you that in a moment. Now, what is fair value actually? So I think he has taken this term and he has sort of applied it to a candlestick. A fair value in the financial world essentially is talking about probability and standard deviation. So basically, if you were to think about this, all of the trading that is happening in the day is mostly happening within one standard deviation, give or take, of the average of the day. And then so a way to think about it is if this were a low in the market, and then we consolidated and then we went up to this high, we came down, let's do it again, we consolidated and then we go up to a high and then we come back down. So the high is kind of this, in the low are these further deviations further left, and then most of the trading is happening in the middle. So that's basically what it is, and I'll show you. And this is a part of the auction market theory. Well, this is not in his PDF, but he's borrowing from terms that come from auction market theory. Here you see efficiency, inefficiency, balance, etc. I just wanted you to see supply demand. I just wanted you to see this theory. And basically, if you think about it, it's a circle they're creating, or again, a sine wave. So you've got the inefficiencies and the fair value, etc. Right? So as we continue, showing you another example, this is fair value, which is basically within that one standard deviation. 1 sigma is another way to say one standard deviation of movement in price from the mean. So from the average, essentially, of the day where all the price is happening, and then we move away from it, and you get this inefficiency. That's what he's saying, but he's saying it in a weird way. This is not new information, right? Now, another way to think about it is, what if you flipped the fair value on its side? Now, I don't know if he's ever said this. It's not included in here. The individual that made this didn't add this. This is my own take on it, from my own interpretation and understanding, but I think it will help you understand. But what if I flipped that on its side and I said, well, what is the fair value of this move, or this candlestick pattern? And what I did is I tried my best to sort of overlay it so that you could see, if you think about it, the fair value is within the middle, right? So that's where most of the trading has happened. However, in this particular candle, there is probably not very much trading happening within this movement, because the trading actually happened further left that you can't see. And we'll get into that in a moment, but I just wanted you to see, I think that's where he's stealing the idea of fair value, and where he's came up with this candle pattern that he's figured out, or that he's seen, or wherever he learned it. I don't know. But that's, if I'm able to sort of extrapolate that, then I doubt he figured this out on his own. It's probably from something else, but whatever. Okay, now here's what he's saying is essentially in the PDF, he's saying that price will, and really what it does is it follows my logic better, I think, because the way I would think about this is a downtrend and this is an uptrend. Again, that sine wave shape. And what happens is the start of the trend down gets tested, and then basically you try to make a new low because you're not making a new trend up, right? So if you don't make a new high, you simply make a new low. But what he's saying is that it gets rebalanced and price moves back into this gap, or this fair value gap, which is not really a gap at all by the traditional term. And basically it tries to create efficiency. Again, that auction theory that he's not telling you about, at least, and from what I can see. Okay, so moving on here. Now let's look at it in reality. What I showed you, I told you I would show you what it really is and how it's actually working. So I found this indicator. It's showing the fair value gaps. I'm not going to be proficient in finding them easily, because I don't trade this way and I think it's silly. But basically, what I tried to tell you is, if you think about it, where where all of these white lines are is my algorithm that's plotting trend, and it's using logic to plot what it believes are trends. Now, what happens is, if you think about this right here, there's a gap, or a fair value gap, illustrated by whatever indicator this is. Now, what's happening is the reason why price stops there is because there's a trend down. There's a significant level here in the market, which is what is holding the price up. It's supporting the price. And what I say is the market gains support. So why this was actually resistance, but it becomes support. And that's why the market is not turning there. Okay. Now, and we could just keep extrapolating this and keep looking at these ideas over and over. And I would show you tons of examples, but that's basically what I want you to see. I want you to understand that the market creates trends, and the inflection points, essentially the opens and closes of markets, where this is where all the volume is typically found in the market, is at the open of the day or the close of the day is where the biggest volume is, because that's when people get up and they go and start trading. That's where the volume is. That's where your levels are typically formed. That's where that distribution comes into play. When I say standard deviation or the fair value, etc., the whole auction theory. So again, price is being supported by levels in the market that are in turn creating trends. And everywhere where you see a trend change is where you know you have a significant level. Okay, so that's all we need to take from that. Now, again, what he says here is there are 3 true support and resistance levels, and this is untrue, completely untrue. He's basically saying that above, at the top, they're calling it a premium level, and then there's a discount at the bottom, and then he calls this consequent encroachment 50% equilibrium. Now, I think this is hilarious because when we move forward, there's a principle in trading that almost everyone knows about if you have any real experience. I think it was heavily popularized by Gann. I think an old timer, Gann, used a 50% rule, and basically noticed that the markets retrace at least 50% of the time, or a lot of the time. And here you can see they're saying 50% when a stock begins to fall after a gain or a rapid gain, it loses 50%. Again, he's saying that 50% equilibrium, which he's calling it consequence encroachment, instead of just saying what it really is, what most people know it as 50% rule. Now, he moves on in the PDF, and we're getting into some stuff that I'm sure most of you have never heard about. He talks about volume imbalance. And basically, he's explaining there are times in the market where the market gaps, an actual gap where the market closes here, and then it opens up here, wicks down, and then never actually comes back to the prior candle and continues higher. And then there are times where it closes here, it gaps up, and then it comes back into the wick and goes higher. Now, there are a couple things that could be happening that a lot of you aren't aware of, but for most people, most people do know that markets close. A lot of markets close, like on the weekends, the futures markets closed. They close for an hour or two every day during after session, the New York session, and as we move through the day, markets open and close for a brief time. And in that time, when they reopen, there's potential for the market to gap because there aren't orders being executed. So fewer orders can move the market. Essentially, there's less liquidity in the market. It is easier to move. Now, what is volatility logic? And something that most of you have probably never heard of, but this comes from the CME. Essentially, there is a propensity that when a lot of trades enter the market and there's not enough orders there to fulfill, or basically, let's say we fire off a trade of, say, 5,000 contracts, but there's not enough liquidity there to facilitate those 5,000 orders to hit the market. If they were to execute, it would move the market away from the current price very quickly, and it would create, we'll say, imbalance or an inefficiency. It would create, it wouldn't make an orderly market, right? So what the CME does is they basically created these triggers that when it detects that these orders are going to be coming into the market too quickly, it halts the market briefly so that the market stays orderly. Now, a lot of people aren't aware of that. And basically, like it says, it closes the market, a brief halt so that the market can't move for a predefined amount of time to basically offset that chaos or lack of order that it would create if those orders were allowed. And why I'm showing you this is because a lot of times that is what I think is happening when you see these type of trades from a scientific point of view. Now, I don't know that for certain, but it makes the most sense to me. Okay, moving forward. Then the PDF goes on and it talks about a 3-bar swing. Now, it essentially says that this is what you use to understand inflections or trend changes, and I agree to some extent. But I found an example, but there are plenty of candles that aren't 3-bar. There are plenty that are 2-bar. There are plenty that are more. A 2-bar would be something like this. Here I've highlighted the 3-bar that you can see kind of following this pattern. There would be a 3-bar here, 3-bar here. So 3 bars happen a lot. 2 bars happen a lot. It's not necessarily just 3, but it's basically showing you inflection. And again, the same thing, just looking at the chart to sort of reiterate what I had said. This inflection is happening at a significant downtrend. So the market, it's in that sine wave, right? But we have to sort of invert it because the sine wave creates trend in the bigger picture, right? So again, that sine wave shape, but think of it diagonally, where trend, like as we're moving through time, it has a directional bias. So what is happening here is the market rallies. And why does it stop here? It stops because there's a significant level in the market here, and you probably see it if you look further left. We can't, and we make a downtrend, an uptrend and a downtrend, and this is essentially creating a level in the market. Okay, without getting too heady and showing you too much, I don't want to. It's a lot to take in, especially if you've been learning this ICT style. Basically what ends up happening is he ends up creating ideas and patterns that are overly complicated. So what is this slide showing you? Again, it's that 3-bar pattern, but I want you to understand that when you see a 3-bar pattern, you can intuitively understand that when you go to a smaller time frame, it's actually making a double top. More times than not, you will see the same pattern. This is the double top or an M pattern. You will see essentially the wicks here are creating that pattern. And the more time you spend in front of the charts, you will realize what is happening. Now, and if you think about why this is happening in terms of trend and logic of trend, basically the move up here is creating an uptrend. And we know by looking over here to the left, these wicks, which is the same area, is testing as a trend down, right? So what happens is you've got momentum being created. Markets have inertia. Newton's first law. Things that are in motion tend to stay in motion until you reach a force or somewhat resistance essentially in the market, or enough orders betting that there's market's going to go down, or that there's just no longer enough people pushing the market higher. And then what happens? You have to offset the momentum that is generated, because look, think about it. This was a big up move. There was momentum generated in this. These two candle wicks, the reason the market tried to go higher, right, is probing higher, is creating this pattern. The patterns are created as a function of momentum because we're looking at multiple time frames. So what happens is it pulls back. There's a level here. So basically the market, if I were to draw this out in a 4-hour, it makes a trend there. This is testing it for the first time. And then if the trend is to continue by simple logic of trend, it should have gone higher and kept going higher, right? But it doesn't. It fails. So that right there is a significant indication that if you're not trending higher, then you're going to trend lower. And basically you're going to try and trend and take out the lows, which is where he says stop orders are going to be resting, but it's actually a function of trend, because that is something that we don't have to assume. We all know intuitively that if a trend is to continue higher, by definition, it must continue higher. If it's trending higher and it stops trending higher and comes back down, it's no longer trending higher by definition. It's common knowledge that you can observe and everyone intuitively understands. We don't have to get into this idea of we're running stops, because it makes no sense. If you think about the GameStop scenario where the markets were going crazy, basically it was mostly done because people figured out that they could buy call options, which ICT almost never talks about options, and they can buy options and force the market makers to buy shares to hedge the risk. So if they're selling you a call option, they're taking a risk because they sold you something. They can lose money. So in order to hedge that risk, they buy shares of, say, GameStop. And in turn, that forces the market higher. If there are enough people do that, it will send the market higher. It has nothing to do with stops. Now, I know it's a lot to take in, and for some of you, your mind is like you're losing. Your head is going to explode. Okay, some of you that you didn't understand anything I just said, but basically, ICT is painting this picture of you versus them, and it's just simply not how it works. It's way more complicated than that. Okay, the idea of running stops is silly. Okay, think of it logically in terms of trend. You can define a trend. You can see it. Okay, this algorithm defines it. All of these white lines are defining what a trend is. There's no guessing. I didn't draw them. It drew them based on the rules that I have discovered and the logic, something that follows math that makes sense. Okay, so just moving on. I just wanted to show you that. Okay, now the next part of the PDF goes into this. Basically, they call it PD arrays, and I think it's ridiculous. It's essentially, oh man, how do I say this? It's essentially taking that sine wave or taking the trend, okay, all of the phases of the trend. So remember, accumulation, distribution, and then this would be the trend phase. But then add actual candlesticks, and you get, you know, this sawtooth type pattern. And basically all of this array matrix that they're talking about is essentially candlestick patterns where levels are formed, and it's just silly. Let's see. And here's an example. And I just found, like, I just try to, I'm not going to say what they are because there's just way too many and it's way overly complicated. I just wanted to illustrate it again. So again, this was the sine wave on the right, just kind of a crude diagram. And this is kind of what it would look like in practice, where markets are trending, all the red lines that you're seeing, and then here are all the levels that are in play that I say are significant. And I'm just showing you how the market creates this wave and then in turn creates new highs and new lows, because that is the rule, that is the requirement to make a trend. For this to be a downtrend, it has to do what? It has to be making lower highs. For this to be an uptrend, it has to do what? It has to be making higher highs, right? Lower lows, highs, et cetera, et cetera. It makes sense. Completely logical. It's just they've overly complicated, and I just skipped over it because I was like, this is ridiculous. I'm going to spend an enormous amount of time trying to go through each one of these. And all you really need to do is learn how to define trend. If you can define trend properly, you will have no problem finding levels, okay? And you will realize that every single pattern is essentially one of these. It's accumulation or distribution, right? That is it. That's all you got to remember. If you can sort of start thinking at it and simplify it, it will make your world way easier to understand. Okay, what else? Then he goes into the dealing range. Man, what do I even say? Dealing range is essentially this school of thought overcomplicating trend. That's all it is. They call it a range. Here's an example. Now they're saying that there are stops. Oops, let me back it up. They're saying that there are stops here and the market runs them. Well, I want you to think about this. Let me explain to you from a liquidity standpoint. And when I use the word liquidity, we're going to use it a little differently, not the way that the ICT crowd thinks. But again, we have this sine wave. We have a downtrend, and then a new uptrend is created. If for some reason this area didn't hold and we got rejected, it would create a downtrend, and we would expect the bigger pattern to go down. But because it goes up, we would then expect, he's basically saying that this is a new dealing range or a new trend, which I agree with. They're just calling it range for a silly reason. Just call it what it is. It's a trend. But the problem is they don't define it. And then they say, well, the stops are purged, when actually they're just needing to make a new trend. Okay. Now looking over here on the left, they're saying sell stops are purged, which really what happens is this is support in the market. It comes up and then it comes back and tests it for the first time. So there is liquidity here, meaning there are people buying this. Now, what happens is if this is a level in the market where people are trading, or if this is fair value, we'll say, this is where most of the trading was happening, these orders here and these two candles are clearing the liquidity here that would be sitting here, the trading happening, it's clearing it so that the market can obey the rules of trend and do what? Make a new low. Did it make a new high here? No. So it has to obey the rules of trend and do what? Go lower. It has nothing to do with stops because we don't know that there's stops there. We really don't know unless you're able to see the orders, the order flow, and see the executions and know for a fact what those orders are. You have to assume. Well, that's not logical. That's an assumption. Use logic. I just explained it to you. Again, why did this high stop? It stops basically because there's a level here. There's a little downtrend in this area the market is using as resistance. And then guess what? Well, this didn't make a new high, so it makes a new low. That's just the basic common sense of trend. That's all we have to talk about. Instead of calling it dealing range, just understand that this is basically a sine wave. It is a sine wave is the completion of a full cycle or a full trend. Okay, moving on. Here I am showing you again the sine wave. It keeps coming into play. Premium versus discount. Again, he's basically giving you the full cycle, and what he's saying is the midpoint or the equilibrium. They're calling it premium. That means don't buy. They don't want you to buy up here. They want you to buy down here, which is essentially the same as the sine wave. The equilibrium, where there's no change in phase. This is a 90-degree phase. This is no change in phase because it's 0, because we're thinking about a circle, remember? So 180, 270, 360. Same type of idea. It's just they're borrowing, from this concept. And I'm showing you science versus, how they think about it. So anyways, what else? And I think that's it. That's really all I have. There wasn't a lot to take from it. It's pretty elementary, but I think you can kind of see, I hope that some of you can see how one is based on assumption and the other is based on logic. And then if you like this stuff, just let me know, and maybe we'll do some more of these. But I hope that helps some of you. I know there's going to be plenty of you that you don't care. It went over your head, and that's fine. It's no big deal. All right? You guys have a good one. Catch you later.